You keep checking mortgage rates, hoping for a number that already came and went. It was 2.65%, January 2021. That's the ghost sitting in your head every time you look today. It's not coming back. Not this year, not next year, probably not while you're still a first-time buyer. And you've been putting your life on hold for it. Here's what I'm going to show you in the next few minutes. The wait for rates to drop strategy that half the internet is pushing right now is built on a number that no longer exists. By the end of this, you'll know what mortgage rates are genuinely forecast to do for the rest of this year. Not guesses, not vibes. The real numbers from the people who actually move this market. Let's start with where we are right now. This week, the 30-year fixed mortgage rate sits at 6.49%. That's Freddie Mac's official weekly survey, the same benchmark lenders across the country use. The week before, it was 6.43%. A year ago, at this exact point, it was 6.72%. A full year passed. The rate moved less than a quarter point. That's it. That's not a market crashing toward you. That's a market that's basically frozen. Here's where it gets a little messy, though. Check 5 mortgage sites today and you'll see 5 slightly different numbers. Bankrate says 6.56%. Zillow's daily feed says 6.72%. NerdWallet says 6.46%. None of them are wrong. They're just pulling from different lenders on different days for different borrower profiles. What matters isn't the exact decimal, it's the range. And that range has been stuck between roughly 6.4 and 6.7% for weeks. Why does it still feel like everyone's holding their breath, waiting for it to break? There's a name for what's happening. It's called anchoring bias. Your brain latching onto the first strong number it saw and judging everything after that against it, even once that number stops being relevant. For an entire generation of buyers, that first number was 2.65% back in 2021 after the Fed slashed the federal funds rate to nearly zero and bought hundreds of billions in mortgage bonds to stop the economy from collapsing during the pandemic. That wasn't a normal market. That was life support. And a lot of people are still budgeting like life support is coming back. It isn't. Here's why, mechanically. The Fed has held its key interest rate steady through January, March, April, and June of this year. No cuts, because inflation is still hot. The Consumer Price Index rose 3.8% over the year through April, the biggest jump since 2023. Core PCE, the specific gauge the Fed actually watches, is sitting around 3.4%, well above their 2% target. As long as inflation stays there, the Fed has no reason to cut, and mortgage rates track the 10-year Treasury yield, which itself moves on the Fed's rate path and outlook, one step removed, with a lag. No cuts upstream, no meaningful drop downstream, in your rate. That's not opinion, that's just the plumbing. So what do the forecasters say is coming? The Mortgage Bankers Association projects 6.5% for both Q3 and Q4 this year. Fannie Mae's latest housing forecast says 6.4% for the rest of 2026. A June Reuters poll of housing experts landed in almost the same place, 6.4% by fall, maybe 6.3% by winter. The most optimistic forecast on the table, Reuters number, is a drop of about 0.2% by winter. Not 2%, 0.2. I know what some of you are already typing in the comments. Sure, but what about next year? Fair question. Even the outlooks that stretch into 2027 barely move. Fannie Mae has it holding around 6.4% into next spring. This isn't a temporary freeze you wait out. Right now, it looks like the new normal. On a $400,000 loan, here's what that means once you translate it into dollars, because a percentage means nothing until you do. Every basis point, 0.01%, is worth roughly $2.50 a month on a loan that size. So a full 0.2 drop, best case, saves you somewhere around $50 a month. $50. That's the payoff for 6 more months of waiting. That's one takeout order. And here's a piece almost nobody puts on screen. Freddie Mac has tracked this rate since 1971. Over that whole history, the median 30-year rate is 7.23%, not 3%, not 4%, 7.23. So when 6.49% feels high to you, you're not comparing it to history. You're comparing it to a narrow, historically freakish window that happened to include the cheapest borrowing this country has ever recorded. That window is shut. What you're looking at right now is closer to mortgage normal than mortgage expensive. I'm not telling you this to make a higher payment sting less. I'm telling you because the whole comparison your gut is running might never have been fair. Now, to be fair myself, a real breakdown doesn't just cherry-pick the numbers that make the best story. There is a bit of good news buried in here. Housing supply is rising. Prices are stabilizing in a lot of markets. So even if the rate holds flat, total affordability could still ease little, just from the price side instead of the rate side. But here's the trap I keep seeing people walk into because of this frozen rate environment. Adjustable rate mortgages are creeping back. Applications for ARMs recently hit their highest share since October of last year. I understand the appeal. That intro rate looks so much friendlier. It feels like a workaround. Except an ARM is a bet that rates will be lower once your fixed period ends. And you just heard 4 separate forecasts agree that rates aren't going anywhere meaningful this year, or probably next. You'd be betting against the data sitting right in front of you. Say you're eyeing a $400,000 house. Lock a 30-year fix today at 6.49%, and your principal and interest lands around $2,525 a month. Now say you wait instead, and rates ease to Fannie Mae's forecast of 6.4% by winter, a smaller move than that best-case Reuters number, but the more likely one. Your new payment is roughly $2,500. You saved $25 a month. But in those 6 months, in a market where prices are still creeping up in most areas even as supply loosens, that same house could easily cost another $5,000, $10,000, $15,000 more. You didn't win the wait. You just paid extra rent on your own indecision. So where does that leave you? If you're financially ready, steady income, a real emergency fund, a home that fits your actual life and not some fantasy version of it, waiting on a rate that isn't coming is costing you more than $50 a month. It's costing you the house, because unlike interest rates, home prices don't reliably sit still either. If you're not ready yet, none of this is a push to rush. This isn't about buying today out of fear. It's about buying whenever you're ready, without holding out for a number that left the building in 2021 and isn't walking back in. The rate was never the villain here. The waiting was. If this cleared something up for you, subscribe. I'll keep pulling numbers like this apart. No fear-mongering, just what the data actually says. And if you're on the fence about buying right now, tell me your situation in the comments. I read every one, and I'll tell you honestly what the math says for you.